In 1998, the smartest fund on Earth nearly collapsed the global financial system. Not because they were corrupt, not because they were careless, because they were certain. Long-term capital management launched in 1994 with a premise that sounded almost boring. Find tiny mispricings between bonds. Bet they'll converge. Collect the spread. Repeat. The genius was in the execution. John Meriwether was the founder. Former Salomon Brothers bond trader. Legendary reputation. He recruited Myron Scholes and Robert Merton, the architects of the Black Scholes options pricing model. These are not household names, but they should be. In 1997, while LTCM was already running, Scholes and Merton won the Nobel Prize in economics. The fund didn't just have smart people, it had people who had mathematically redefined how the world prices risk. And that was, in hindsight, part of the problem. Their core trade was called convergence arbitrage. When two assets that should be priced identically trade at slightly different levels. You buy the cheap one, short the expensive one, and wait for the gap to close. The spreads were tiny, sometimes fractions of a basis point, so to make meaningful returns, they needed size. At peak, LTCM was running 25-to-1 leverage. That means for every $1 of their own capital, they controlled $25 of assets. Their equity base was roughly $4.7 billion. Their total asset exposure, over $125 billion. Their off-balance sheet derivatives notional, somewhere near $1.25 trillion. Trillion, with a T. The model said the risk was manageable. History, they said, supported the thesis. History, it turned out, hadn't finished writing itself. August 1998. Russia defaults on its domestic debt. On the surface, this shouldn't have mattered much to LTCM. They weren't heavily positioned in Russian bonds. But markets don't behave like spreadsheets. When Russia defaulted, fear spread. Investors fled anything that felt uncertain. They ran toward the safest assets on Earth, U.S. Treasuries. And every trade LTCM had on, every single convergence bet, diverged instead. The spreads that were supposed to close widened, then widened more, then widened in ways the models said had a near-zero probability of happening. The models assigned a 1 in 10 million year probability to what happened in a single week. There's a word for that, it's not bad luck. It's called fat tails, the phenomenon where extreme events happen far more often than a normal distribution predicts. The Black Scholes model, beautiful as it is, assumes a world where disasters are rare and predictable. Real markets are not that world. In August and September 1998, LTCM lost $550 million in a single day, $1.9 billion in 1 month, $4.6 billion total in under 10 weeks. Their equity was nearly gone. But here's what made this a systemic crisis, not just a hedge fund blow-up. Every major bank on Wall Street had either lent money to LTCM or held positions on the other side of LTCM's trades. If LTCM was forced to liquidate, if they had to dump $125 billion in assets into a panicking market, the cascade would have been catastrophic. The Federal Reserve understood this. In September 1998, the New York Federal Reserve did something extraordinary. They didn't inject government money. Instead, they convened a meeting. They called in 14 of the world's largest banks and said, essentially, "You're all exposed. If this unwinds badly, you all suffer. Work it out." The banks agreed to a coordinated rescue. $3.6 billion injected by a consortium. LTCM was taken over. Positions unwound slowly over 2 years. The system held. Barely. People like to say LTCM failed because of arrogance. And there's truth in that. But I think the deeper lesson is more uncomfortable. LTCM failed because their models were internally consistent but externally fragile. The math worked, the backtests worked, the logic worked. But the model was built on the assumption that the world was rational, that other participants would behave as expected, that the past was a reliable guide to the extremes. When real humans get scared, they don't optimize, they flee. And when everyone flees in the same direction, the elegant arbitrage becomes a trap. Risk is not what your model says it is. Risk is what happens when the model is wrong and you have no room left to survive being wrong. LTCM had no room. 25-to-1 leverage gave them no room. The fund with 2 Nobel laureates lost $4.6 billion in 10 weeks. Not because genius failed, because genius forgot it could. The market can remain irrational longer than you can remain solvent. I'm Hana. If this made you think, subscribe.